Well, let's get started. It's 12:01, so let's be respectful of everybody's time. We're so excited that you guys are here in the middle of the day. We've got amazing information from Aaron. As some of you know, some of you may or may not know Aaron, but I've personally known him for what, almost 9 years, Aaron?
Something like that, 9, 10 years.
It's been a long time. We've been to a lot of real estate conferences before COVID when we had real estate, a lot more real estate conferences. Aaron's always been really great with, an audience or with people, just because we want to get out the information to a lot of people about what he's going to say. And so we just figured this Zoom call was going to be perfect. It would probably save Aaron, how many people are on here are going to watch this? This will probably save you 30 phone calls, Aaron, at least.
And I don't mind the phone calls. I love the phone call.
It's true. You do. But it's nice to get it out there. At the end, we're going to open up to a Q&A, you guys. So if you've got questions, you can just write in the chat. Bree is hosting this, and she'll make sure that you can unmute and ask Aaron your questions. We've got Nate here. Nate works with me here at Narada. He's an investment counselor. I'm an investment counselor. And we're just excited to dive into all this good stuff, Aaron.
Dude, this is gonna be cool. This is gonna be very, very, very cool. And of course, she just introduced me, and I want to let you guys know the same thing. What Melissa said. We've known each other for 10 years. Thereabouts. We've been to all kinds of conferences together. We've spoken different environments together. We've checked out crazy markets together, done a lot of business on the personal side and on the professional side for our own personal businesses together. We're using her services. Nate and I had got connected years ago through other channels within the real estate investment space and his clients. And it's one of these things that we don't get opportunity enough to be face to face at all. The three of us. This is the first opportunity I think we have the three of us, been face to face together. As face to face you can get electronically, right? But to me, I'm excited that one, they trust me to bring me on to talk to you guys and share with you the information we've got. And then one, I get to pick these brains. With what they do and the history they both have and the expertise they bring to the table for you as a real estate investor, you're literally getting the operations department or operations division to your business for free by working with these guys. And I cannot tell you enough how much you should at least feel better about what you're doing by putting them on your team. Number one.
Thank you.
Yeah, we appreciate that, Aaron. And from the lending piece to working with Melissa, whether you're working with we like surround ourselves with good people and knowledgeable people. And that's the whole point of what we do at Narada, and linking people up with you, at your company as well. So, and guys, just to give myself a brief intro as well, I see some of my clients on here. Hi, Joy, how are you? Good to see you. I've known Melissa for years. I've known Aaron for a decade through different mediums. I as well have gone to events, and Melissa and I just traveled the last couple of months as well. If anybody's here from the recent Arizona event there. But we're excited. I mean, buckle up, guys. As I say, grab a pen, grab a notepad, grab a calculator, because we're going to be doing some stuff today. Aaron's going to obviously, we're going to talk all things investing and finance. So again, guys, appreciate you being on. And Aaron, if you want to take it away, feel free, my friend.
Sure. So the thing that I see the most, I write a blog. I don't know if you guys have ever heard of, there's the best real estate podcast ever, whatever. I can't remember. But they asked me to write for their blog. So I've been writing. I decided to do the ChatGPT thing this last week. And the one thing I wanted to figure out is what is the most commonly asked question when it comes to investment real estate? And it is how to get started in investment real estate. And what I find is very interesting about humans, and this is a quote that one of my business partners like to say all the time, it's the start that stops most people. Most people don't even get started. They think about getting started like crazy. They'll attend meetings, they'll watch webinars, they'll go on to chats, they'll do all these things, blogs, but they never get started. And the thing it is, I think, is the biggest worry that most people have is when's the right time to get started? They're trying to time the market. Well, let me just explain to you that that trying to time the market is like being a star football player and sitting on the sidelines, on the bench, conserving your energy, waiting to jump into the perfect play to get on the highlight reel. The only people that ever end up on the highlight reel already have their ass on the field, period. So if you're trying to time the market, don't even attempt. The only way to time it right is to already be in it. already be doing it. And ultimately, you'll be doing something on your regular routine basis that happens to hit the right time. So when you're talking about that, the biggest worry people have right now is their interest rate. Well, with interest rates going up, how can I even be assured that it's a good time to buy real estate? Because what you've been told for the last 10, 12 years is cash on cash return, or cap rates is what you need as the metric to be able to determine which property you want to purchase. That's not the metric that you want to use for determination anymore. What you're looking at is to understand what's going to drive value for you. So we're going to start in the math equation in this, because cash on cash return is still doable, but that's the cherry on the sundae. Set that aside. Stop thinking that way for now. If you, at the end of this, when I'm done with what we had to say between the three of us, Melissa, Nate, myself, and you're like, nope, idiot, I'm not doing that, going back to cash on cash return, feel free. But just allow us the moment to just dig into your head just a little bit and show you where we can create 20+% return on your investment without having to think about cash on cash. So we're going to set some baselines. I'm going to let Melissa and Nate tell me whether or not I'm wrong in my baselines. We're going to say 200,000. Now, this is when you get your pens out, guys. So when you start taking notes, $200,000 acquisition price. We're going to say we're going to do 20% down. We're going to say you're doing a 30-year fixed. I know I'm talking fast. So $200,000 acquisition price, 20% down, 30-year fixed loan, $1,800 a month rent. And this is where it's going to hurt. I'm going to say you're only getting $100 a month in cash flow. Again, I'm stepping on this cash on cash return thinking just for the moment, right? The only reason I'm stepping on it, because too often we've made that the target. That's not the target, right? That is the ancillary benefit. Yeah. So if we've got a $200,000 acquisition price and we're putting 20% down, what dollar amount is that, Nate?
40K.
40K. He's already ready, guys. He's already doing the math. Dude already knows, right? 40,000 invested, right? So Melissa, how much is your loan amount if you're getting a $200,000 purchase price and putting 40,000 down?
Your loan. Well, what's the interest rate?
We're just talking about the loan amount itself.
Oh, the loan itself, your loan is going to be 160,000.
160,000. So, Tyler Bolton's jumping in there. Yeah, I know that man. There we go. I met him in. So you had $160,000 loan. So let me tell you what your main focus is as a real estate investor. Your main focus is to find an asset, a business, a property, all the same thing that you can keep reasonably rented for the entire time you own it, and you can raise rents on it. Those are the things you got to worry about. Now you got to find the right people. You got to work with Nate, Melissa, people of that caliber, not just some idiot who puts a sign up on the street, right? You got to talk to somebody who understands real estate investing that will guide you as your operations division. But if you find a property you can keep reasonably rented for the entire time you own it, and you can raise rents on it, who pays off that $160,000 loan, Melissa?
Your renter.
Renters do, or group of renters over the period of time that you own it. So here's the next bit of math we're going to do. $160,000 loan paid off by your tenants over 30 years. So 160,000 divided by 30, what do you get? Nate.
5,333.
$5,333.34 to be exact, correct?
Yep.
Now, you said you invested how much into the deal?
40K.
40K, but you have costs. So now a lot of people like say, oh, wait a minute, you still paid more there. So let's say you paid 10,000 between lender fees, title fees, appraisal, inspections, taxes, insurance, points, all this crap. So you went from 40,000 invested to 50,000 invested. But your tenant is literally paying down, averaged over 30 years, $5,333.34. What percentage is that of 50,000, Nate? Hit your divide button, type in 50 grand.
Yep. 10.6.
10.6. Literally, just by having the right people to work with that guide you to the right area and you deciding on the right asset that stays reasonably rented for the entire time you own it, your investment of 50,000 grows on an average of 10.6% year-over-year average over 30 years. Where else are you guys getting that predictably? Or can you reasonably predict a 10.6% increase? It's just not find it. You can hit it now and again in the market if you stay long enough, but it's never consistent. So we're going to shelf that for a second. We've just discovered 10.6%. Now, we live in an inflationary environment. The rate of inflation, the Fed's trying to say it's in the low 4 or 5, something like that. We all know that's bullshit. Consumer price index, or CPI, is the most mislabeled thing that's ever been produced in the history of mankind, right? Other than the Kennedy assassination. But when you take the CPI and you factor in what the real rate of inflation is, we've been well above 8% since the 80s. Well above. We're about 12 to 13 right now when you look at the real rate of inflation. So because of that, our property values are going up, or the cost is going up. Now, what we're seeing is appreciation. If you look at the Case-Shiller index, they're saying appreciation is going to be somewhere in the range of about 6% last year. They're anticipating 5 to 6% this year. So let's take that 5% and cut it in half. That's 2.5%. So Nate, if you've got a $200,000 house and you're getting a 2.5% increase in its value the second year, how much is that?
$4,000. Well, it's 2%. Sorry.
So it's 2.5%.
2.5%. Let me do it again.
So 200,000 times 0.025.
$5,000.
5,000. So
Yeah.
Melissa, 5,000 is what percentage of your $50,000 investment?
No, I stopped calculating.
Well,
Dude,
what's
10%.
5,000 is what
So
percentage?
much
of 50?
pressure.
I know. I put you guys under the gun. It's 10%.
10%.
I'm like, it's not working.
It's like, I'm a market person. I'm not the math person. So
No.
literally, if you have a property that increases by 2.5%, plus the way I ask the question sometimes is different than what you're ready for. So if
Yes.
the property increases by 2.5% its first year, that means your investment of 50 grand went up by 10%.
Right.
Literally 10%. So you're looking, yes, Benny, I do have a cheat sheet. It's all right here, actually. I've been doing this presentation 100 times. So so I use numbers I've already calculated well in advance. Memorize this. So you're at 20.6%, literally just by keeping somebody in the house or group of people in the home before any cash flow comes in. Even if all your cash flow went to just keep the property fixed, keep the property, deal with any costs when it was not vacant or when it was not rented and it was vacant, and all you did was pay down your mortgage, and all you did was have 2.5% increase in the price or valuation of the home and appreciation year after year, you're at 20.6%. Who here is going to bitch about a 20.6% increase in your investment? Hopefully nobody, because it's not consistent anywhere else. That's your basic baseline of real estate investing. Now, when we start getting into the cash on cash return situation is where to me, it's great, but it's also a double-edged sword, because a lot of people get so focused on it that what ends up happening, they'll do anything they can to find this cash on cash return. And sometimes they'll cut corners. They'll talk with the wrong people. They'll just look at the performance that looks sexy and they'll just hang their whole hat on that. And 2 years from then later, the house has much more problems than what they anticipated. Trying to keep it rented is really, really hard. And all that money they supposedly were making in cash flow is vaporized to expense. Don't get suckered into that. That is basically a siren song that's dragging you down to a financial debilitation if you're not looking at all the other baselines. So understanding those two things, if you can reasonably predict that. Now, I don't know it's extremely predictable, but that's where you have professionals here to help you figure that out. Now, let's talk about that $100 a month cash flow, which nobody's excited about. What markets? I'm going to ask both you guys just your opinion, Nate and Melissa. Since we live in an inflationary environment, we get to raise rents. How much are rents going up by year over year in the United States right now?
2-3% maybe.
Depending upon the markets, right?
Depending on the market.
Markets. I mean, there's some markets I'm still seeing 8 to 10%.
Yes.
Certainly. But in a standard like Midwest turnkey type market, what would you say, Melissa, 3%?
Yeah, 2 to 3% is pretty average in a nice B class. Now, if you're like in a C class or less, we certainly wouldn't expect higher rental increases. And that's what Aaron was just talking about is, making sure you're in the right investment and you have those expectations.
And that's the truth also. But, I got kids that are living in apartments. I've got my oldest is 26, I think now. I've got 26, 25, or 26, 24, and 22. They're seeing $200 a month. The $200 a year month increases year after year. So they're bumping their rents up significantly.
Yeah.
So you start seeing what's going on out there. 3% is a very, very reasonable number to use.
Yeah.
So we were talking about $1,800 a month rent on this $200,000 property, only producing $100 a month cash flow. What nobody wants to hear. So if your $1,800 a month rent went up by 3%, how much did it go up by, Melissa? So 1,800 times
$54.
$54, right? Is anybody getting excited about $54? Nobody on this call would get excited about $54. But here's who also doesn't get excited about it: the tenant. They don't give a shit about 54 bucks. Like, wow, that was only 54 bucks. They are not going to move out on you for $54. But what happened to your cash flow? It went from $100 a month in cash flow. Steve will lead to 54, another 54 bucks, now 154. I'm not going to bother any of you guys with this math, but that's a 54% increase in your cash flow. 54%. Every time you raise the rents by 3%, you get a double-digit increase in your cash flow. Think about how amazing that is. That right there starts to compound to become something huge. Too often we get so locked in on this first 12 months cash on cash that we fail to think, what's year 2 look like? 3, 4, 5, 6, it looks like.
Yeah.
If you bought the right property, right, that stays reasonably rented, and you can keep renters into it because you're only raising by 54 bucks, and you've got little capital expenditures because you bought the right house, not some piece of crap that's going to fall apart on you but your cash flow is awesome the first year. You start to see how your business starts to take off. Nobody ever started a business off because they're going to be cash flowing day one. They started a business off because they had 3 to 5 years worth of reserves that they can continue to grow their investment. Now, got somebody right now that there's a limit on investments in certain areas. Don't invest in those areas, right? There's other areas. That's why you have Melissa. That's why you have Nate. They go and hunt these areas that are going to help you to be able to compound that growth. Now, the big sexy thing here is, does the lender get to increase the payment on the loan because of inflation? We get to raise the rents, but does the lender get to do that, Nate?
No, negative.
And why not?
Well, it's a fixed locked-in interest rate for 30 years. Unless you refi, there's some type of addendum, or it's a variable rate. No more. Normally it's a fixed rate.
That's one of the baselines we just set, a 30-year fixed. Now, some people, again, that cash flow siren is going to be, echoing in the background saying, go with the ARM because you get a better cash flow. The ARM is literally, it's a very, very destructive instrument. Does everybody know the name Warren Buffett here? I'm hoping so. I'm going to go on the extraordinary assumption you all know the name Warren Buffett. He said that the 30-year fixed is the greatest financial instrument in history because it's a one-way bet. If you're wrong, you just refi. But if you're right and the rates go up, you've protected yourself from potential financial devastation. Now, do you know the name Charlie Munger? Melissa and Nate?
Nope.
Okay, so you ever watched the Berkshire Hathaway Berkshire Hathaway shareholders meeting?
Nope.
Okay, so wow. Okay, so Warren Buffett is one of the owners of Berkshire Hathaway. His business partner is Charlie Munger. If you ever watch them, just pull it up right now. Just pull up the Berkshire Hathaway shareholders meeting, and then you've got this Kermit the Frog looking sumbitch sitting right next to him with glasses. That is Charlie. Charlie's 10 years old. I believe he's 10 years older than Warren. The guy's been around a long time. He's almost 100 years old. He was in an interview, I believe it's CNBC, with Aaron Burnett. He had said in this interview, and I had a clip from it that was cut and distributed all over the internet, that said that we had 40 years of declining interest rates. We are going to experience 40 years of increasing interest rates. I click on that link now, you can't get it. It won't play. I have spent 6 to 8 hours, I didn't time it, but it was a long damn time, looking for every version of that interview. It's been taken out. I downloaded the transcripts, it was redacted. They don't want you to think this or know this because those ARMs are a very, very good thing for the banks, not a great thing for you. Now, where I was heading with this, 30-year fixed. I got off on a tangent about that. So it's 30 years. So since the lender can't increase the payment on the loan, they have to accept the exact same dollar amount for 360 months. But is the dollar worth the same in 360 months, Nate and Melissa? No.
No.
So I like to use 8% as a baseline. If you guys have your phones right now, some of you are probably on that listening to this, you need to go to your app store right now and download the QJO investment tool. It's on the Apple store. It's on your Google app store thingy. But it's the QJO investments tool. It stands for the Quit Jerking Off Investment Tool. The reason I named it that, because anybody who's chasing around interest rate, that's all you're doing. You're wasting time on something of zero value. What this will do, and we'll get this out in an email, show notes, whatever we got here. You can, when you download it, if you want the information on this, actually, I've got videos on how to use this tool. It'll show you the time value of money. Put your email in the chat. Bree will copy it. She'll email you right now the videos on how to use this tool. So, sorry, Bree, got more work for you to do. So what this tool will show you is that at today's interest rates on a $200,000 acquisition, putting 20% down, you're going to pay about $400,000 in principal and interest on this loan. Most people would be tempted to pay it off faster, like, oh crap, man, I need to pay this loan off because I'm paying all this principal and interest. Don't think that way. You can do that on your primary residence because it's a big expense on your primary, but when you talk about your investment properties, let these other people pay it off for you over that period of time. So what you end up with, as you start to factor in the value of inflation and how it erodes the dollar, 0.666 per month, averaging 8%, you're going to find you didn't pay $402,000. You didn't even pay the 160. It's about 152,000 and change in actual dollar value, because you take 160,000 as its value today. You buy your asset today that you have somebody else paying off for you today, that's going up at 2.5% at least in value today, that you're able to increase rents on from today's dollar value, and you pay it back with tomorrow's dollar value. This is the first tool on the planet that actually gives you this power in your hand to calculate this out. And what this does for you is there is tens, if not hundreds of thousands of people out there wandering around aimlessly trying to figure out, how do I do real estate investing in an interest rate increasing environment? How do I do it when I can't get cash on cash return? How do I do this right now when I'm spending all this money on principal and interest because the rate's going up? They're not going to do it. Again, we established at the beginning, it's the start that stops most people. Let them stop while you start moving forward. This is the greatest opportunity you have ever had to step into real estate. And what's really interesting, people are lamenting the rates going up, but you didn't bitch really, really loud when you started to purchase a property and your realtor said, be ready to come to the table with a 30,000 above list just to get in the game. Well, they're like, well, that's just how you play the game. Well, you're already spending the money you were saving on interest by giving it to your seller. So you don't have those people now fighting with you over that property the way that they were in the past. You don't have to spend the kind of money to get in the game. You might even get the seller to throw some money in for points to buy down your interest rate or pay some of your costs. Yeah. That's the reality today. So don't get so wrapped up in this. Now, the big thing that people want to ask is, where are rates going? So let's talk about that, because we just said, Charlie Munger was talking about how rates are going up. Well, let me show you some actual evidence as to where they were, where they're going, where I believe they're heading. So I'm going to do a quick share screen here. I had to swap screens around, so it looks like I'm looking everywhere but where I should be looking. All right. So what I'm showing everybody here, and it probably hasn't popped up yet, still loading. I'm going to show you the mortgage-backed securities. Now, this, if you've seen The Big Short, they've talked about the mortgage-backed security on The Big Short. Lou Ranieri from Solomon Brothers was looking at how the banks were able to take people's deposit capital, putting into a checking account, savings account, CD, give them a small return, but then charge like 12, 13, 18% on the money being lent out to the same community. He's like, why don't we do this on a global scale? So they got pension funds, and they've got mutual funds, and they got hedge funds, and all these money, people throwing money into these pools. They would lend out, pay them a flat return on the money, but they'd lend it out on a margin, and they would make more money on it. And in the bond markets were making a fortune. So what I have here shows you the one specific pool, the one that we're pulling money from right now to lend to people. It pays back a return on investment to anybody investing in it at about 5.5%. But the interest rates are much higher than that because they got to make the margin. I'm going all the way back to 2008. This goes all the way back to May of 2008, illustrated here. It's probably hard to see it on screen, especially if you're on a phone. But what I drew here, there's this yellow line that goes across this chart. And where I charted that yellow line at is the day they announced quantitative easing. You guys may not be familiar with that, or you've heard that, or it's really kind of echoing in the background of your mind. It's a big ass way of saying the Fed is going to dump a shit ton of money into the market, right? You had people scared to lend in the market. You had people scared to borrow in the market. So what the Fed did, it's like, we're going to take a lot of money from the U.S. Treasury. We're going to filter it into the bond pools and into equities. We're going to filter it into actually mostly just bonds, but they're filtering into treasuries, mortgage-backed securities, and to corporate bonds to stimulate the economy, throw enough money out there that people need to spend it. So that day they announced it, a ton of money went into these pools, started to spur the lending again, and it stayed above that line. So meaning, heavy supply of capital ever since that date until we get to somewhere in the range of about September of 2022. That's when we crossed back below that line because the Fed was out of it. The Fed announced their quantitative tightening. Actually, back here, they tried it. It got ugly. They went back into it. They announced their quantitative tightening definitively, meaning they're going to stop reinvesting. Every time they get paid off, they get paid back, or they get interest paid to them, they're going to keep it, not putting it back into the market or the economy. Interest rates tripled as a result of that. So why is it important for us to talk about that? Interest rates were low, and they had been low because of that factor and that factor alone, because the Fed was dumping in a significant amount of capital into it. You are going to have an opportunity to talk with a lot of lenders. There's a lot of people going to say, we're going to get back to a normal market. So an ARM rate would be just fine. You can refinance when the rates go down. We already talked about what Charlie Munger said, one of the most respected people in the business world and in the markets, saying we're not going back down. We established where the price point, or where that security was at in 2008 before the Fed started injecting capital into it. So if that's the case, if we don't have the Fed injecting capital into it, what is a normal market? So let's look at what I believe a normal market to be. I've been at this since 1997. I've been studying this stuff since 2001, because I didn't realize what drove interest rates anyway until I talked to some bond traders and they helped me understand it. So I'm looking at the same security we lend from. This here is what's called, there's a blue line, you'll see it going across the top. That's the 200-day moving average. Traders will look at the average price point over a long period of time, anywhere from 14 days to 21, 35, 50, 100, and 200 days. What you will notice here is every time the security traded above 200 days, people sold off because it was overvalued. They did it again. It keeps using that as its peak point to trade into. Therefore, the interest rates get to its lowest point, where it gets to that 200-day moving average, it sells off, interest rates go up a little bit. Now, what's interesting is it crossed that point May 25th of 2023. The 200-day moving average crossed that same price point that was established in 2008 before the Fed started putting money into the mortgage-backed securities. I believe, my personal belief from watching this thing for so long, I'm going to move this over, that this is the lowest point that we will see interest rates for the foreseeable future, is right in here. We are going to trade in this area. Those securities will trade in that area. Therefore, the supply of money will be in these lower areas. Therefore, the interest rates will be slightly higher than where we are today. Now, another interesting thing, when you look back on the history of interest rates, especially on the 30-year fixed, is I pulled data directly from Freddie Mac. And when I pull data from Freddie Mac, I have over 2,600 and some odd lines of data showing the weekly interest rate published by Freddie Mac. And when you average it from 1971 all the way up until today, right? It was June 22nd. The average interest rate for people buying houses to live in was 7.74%. That's the average rate for people just to live in the house, to buy it as 30-year fixed, to occupy it, not as an investor. If you take out quantitative easing, which we just established what it was, the Fed dumping in all this money, $8.9 trillion to be exact, the average interest rate from 1971 to 2009 for the homeowner was 9.12%. So where are we heading? That's what the market was like before the Fed's involvement. This is the first time in history we have the Fed going for 13 years dumping money into the economy. So if you have people that have been doing this industry for less than 13, 14 years, they don't know what a normal economy is. They've never seen it. Since I've been doing it for as long as I have, and I got staff members that have been doing it since the 70s, we have a little bit different perspective. So if we average from 2000 to 2008 off of these sheets directly from Freddie Mac, that's where I believe we're going to land. I could be off by a little tiny bit, but I don't think I'm off by a lot. The average rate from 2000 to 2008 was 6.48%, as evidenced right here. So that's for people buying houses to live in. So that means we as investors, we're going to be somewhere in the 7s to 8s, because the average difference for real estate investors is 1 to 1.5% different in interest rate from your home owner. So people look at where we're at today. We're seeing interest rates in the mid-7s for real estate investors, charging a couple of points on the average. If we went to a 0-point loan, it'd be over 8%. The reason I believe, I don't have any definitive data, I'm not sitting in these dark closets with all these economists figuring shit out. I believe the reason that they are not releasing these rates up to 8% is they have programmed us to refinance every time the rates go down. So if we had a situation where they're releasing at 8% at 0% interest, right? And we do know that 200-day moving average it's going to continue to bounce in there, right? We're going to have days and anomalies, it goes above it. People would be prone, if they got an 8.5% rate today at 0 points and they saw it move somewhere in the range of about 7.5%, they would be all about refinancing that rate. That could happen over the next couple of years. If that did occur, then what you'd have is you'd have all this mass refinancing going on, and those who securitized that loan, who took those loans, packaged them up, bundled them, securitized them, and then put them into a servicing portfolio, there's going to be an enormous amount of capital lost. So what they do, they only offer the rates that they can charge you a couple of points. That way you stay in the deal for a couple of years, 2-3 years, so they can make their money back before they start to make a bigger return on investment. So that is why I believe it's being done that way. The main point behind all of this is, one, to let you know the interest rates, I don't see them getting better. So if you're holding out for that, quit holding. Number two, interest rates don't really matter, because think about that. We already showed you where your value is in your real estate. You're going to continue to compound your return on investment. You get to raise rents. We haven't gotten into rent raise yet, have we?
We did talk about it for a
A little
second.
bit, a little bit.
For a quick second, right? So 3-5 years, we did that whole 54% increase, right? If you over 3 to 5 years, you can see you're going to achieve those cash flows you're looking for anyway, right? So being in the game now gives you the capability to get to that point faster. And then we also know the bank's not going to make any money off of you, because you're going to stay in this thing for a certain length of time, or at least the entire length of time, unless you need to sell a property or refinance it to pull cash out and buy again. Now, let me talk about refinances for a second, especially cash out refinances. That's more expensive these days to cash out refinance, just the way it is. Why? Because we're in a higher inflation economy. The Federal Housing Finance Administration has control of Fannie Mae and Freddie Mac. They are still in conservatorship. After the crash of 2008, they're brought into conservatorship by the government, and they said, we will release you when you're profitable. They have been profitable for a very damn long time, but they now get to get some of that siphoned off by our federal government, and they were using it to pay for other crap that still putting us in a deficit. What they've done is they've increased what they call an LLPA, or loan level price adjustment, for many things. One of those being a cash out refi, because they want people, if you're going to pull cash out, they know historically when people pull cash out of their house, they buy boats, they buy cars, they spend money in the economy. Well, the economy needs to slow down. They need to stop spending money. That's why they're stepping on interest rates. That's why when the Fed raises the rate, it doesn't correlate to mortgages. It correlates to cost of living. So that way people slow down their spending and bring inflation down. That's what they're trying to do, is help quell inflation with this. So they're charging you more money to do a cash out refi. So you never pay cash for a house to do a refinance to pull the money back out unless you talk to me first, not any other bank. I'm cautioning you heavily on this. I don't give a damn if your brother-in-law is a banker. You talk to me, because there is some things that are going on in that, and you set it up a certain way to ensure you get your money back out. Because if you don't set it up right, your money's stuck for a year, and it will cost you a significant amount to get it out. Again, I'm not trying to crap anybody else in the industry. They just don't get it. I've been doing this too long with too many people, have too damn much experience, and I've seen too many transactions for me to be able to not know what's going on. Other guys don't do that, right? There's over 1.1 billion people in this industry that I'm doing who does the exact same job I do. I was ranked number 7 last year in the United States for transactions closed, number 1 in the real estate investment space. Go look it up. It's on the Scotsman Guide. You also check out this outfit in Modex. That's why I know, because of experience. Good judgment comes from experience. Experience comes from bad judgment. Don't exercise bad judgment with the wrong people. Not that they're bad people, they just don't know. So with all that, I think I'm going to let you guys take it and run. That's what I've got, because I'm going to get them. I can bitch about interest rates for days.
I don't know. Yeah, what do you have to say, Nate?
Go ahead, Melissa. I was going to say, just shake it out, guys. This is a presentation, I mean, are your brains exploding yet and hurting? Yeah, it's such good information, Aaron. Such good information, and well done. I've got my notes, guys. I don't know if you guys have notes, but good stuff. And I think my biggest takeaways, one, so far have been, now's a great time to buy, regardless, right? Rates aren't going really anywhere, in my opinion, right? They might even go up a little bit more, right? Who knows? So, I mean, that's our opinion.
They have to. They have to.
So rates are staying kind of where they're at for now, guys. The other thing you talked about, which is one of my main points with a lot of my clients as well is profit centers in real estate, right? The opening was amazing. Just talking about what your $50,000 down payment does for you. Mine it. We weren't even talking about cash flow. We weren't talking about write-offs and tax benefits. We were just talking about simply what your money's doing when you have a tenant in place. And what were we talking? Maybe 2.5% increase in appreciation, right? And you know, you'll talk to some of these guys that invested in the 80s when interest rates were super high, and you know, they're breaking even all day, right? They're owning the asset long term for the benefits of that long-term gain, right? So you drove home a great point there. So I know, Melissa, you probably have some things to add as well. So
yeah, well, and I think the biggest thing that Aaron was talking about, and one thing that we all need to remember and drill into our heads, is this is not a get rich scheme. Like, nobody is saying like, hey, you're gonna, you know, make all this money year one, and that's why we're doing real estate. This is a long-term strategy, and that's where the true wealth comes in because of all the inflation things that Aaron was just talking about. That tool is awesome, Aaron, and thanks for reminding us about it. And if you guys missed that, Aaron has an app, and on the chat, Brie is getting all your emails if you guys want to download that. I used that when you first had it, Aaron, as a demo, and you guys have made a lot of changes since then. And then the last time I used it was actually a property you were analyzing for me to buy for my own portfolio, because Aaron's done a lot of loans for me. And then I kind of forgot about it again. And so, Aaron, I'm like slapping myself right now for kind of forgetting that tool. It's really awesome because it really shows you guys the long-term wealth creation. And that's what hedging inflation and appreciation is. It's a wealth creation. And so I want to like change that wording. So when we start using wealth, it's like when my husband's grandma bought real estate in Los Angeles in the 1960s and 70s. And everybody's going, well, you know, she bought 5 houses, but why didn't she buy 100? Because that, if we could all go back in a time machine and buy houses back in Los Angeles before this mass, you know, appreciation or inflation, you know, has happened here. So it's all the same. It's like today, you have that opportunity now, the same as my husband's grandma had, you know, in the 70s and 60s and 80s and whatever. We have that same right now. 20, 30 years from now, people are going to be saying that to us, our kids, our grandkids, and go, why didn't we buy 20 or 30? It's literally the same thing as Aaron was talking about in the inflation. What'd you call it? The inflation charts that you were talking about.
Yeah, it's just the erosion of the dollar. And, you know, one of the ways to kind of illustrate how this works, and Ashwini, you definitely want to get the app, because I will go through an exercise here real quick with you guys all using the app to answer the question, because there's another question just put in here. Can you please repeat again why we shouldn't focus on paying off the loans, especially investment properties? So everybody get your app. We'll go through that thing together, and I'll guide you through it. But one thing to kind of illustrate what that whole time value of money a little bit better. And I don't remember the exact year, so don't bust my balls for the year that I use here, but I'm gonna say it's the 40s or 50s, maybe even been the 60s, that you can get an ounce of gold for 20 bucks, right? And so this is something that I was told. I mean, I'm just repeating. I haven't done the research, and I usually don't do that. I usually do it after research, but this really was telling to me. So an ounce of gold for what the time it was $20, you can use that same $20 or an ounce of gold to go in and have a tailored suit, a shirt, a belt, a tie, and a pair of shoes and a pair of socks, and you can walk out with that. Right now, I don't usually go shopping for that kind of thing, but I recently have. I've had 2 suits tailored and all stuff, because I've had to go to the nation's capital, speak in front of senators and Congress. Yes, my beard, my face, but you know, glossed up a bit. So what I found was what I spent for the suit. I didn't get a tie. I don't wear ties. The shirt, the belt, and I already had the boots, but if I figured in the cost of boots or some decent shoes at the time, I would have spent what it cost for an ounce of gold today. So what's interesting is the value of the gold has been the same. What you can buy with an ounce of gold has been pretty much the same. It's just our exchange rate of the gold is different because the value of the dollar is declining so fast. What's also interesting about the stock market, if you get some people to really break it down, the stock market has gone so high, right? 30,000, but it's spiked up like that because the value of the dollar that you invest in it is worth less. When I got in the industry in 1997, I remember when the guys in the same building running down the corridors, an open courtyard with their shirts off from the Charles Schwab office because the Dow just hit 10,000. Our value of our dollar in that period of time has lost that much, 2/3 of its value basically over that period of time that I've been in the industry. So if you guys got your tool open, the QJO investment tool, please launch it right now if you have not. Scroll down to the third calculator on there. I'm going to go to it myself. It's a mortgage amortization schedule. That's the calculator we're going to use right now. We're going to use the same baselines that we talked about earlier. So you're going to type in where it says down payment, type in 20 for 20% because it's a percentage, right? So type in your 20. Purchase price, 200,000. Now, don't get too cavalier with the zeros. I've seen people do 2 million, 2,000, 20,000. It's 200,000 we're going for here. So be cautious about that. Annual interest rate. We're just going to all do 7.5. Just so we have that, and you're going to hit calculate. Don't put anything for additional payment. Additional payments, if you want to play around, see what happens if you add an additional $100 to your payment every month. I think you don't want to do that, but I put that in there anyway. Now you can see as you scroll down how much your payments are and how much your balance is still left. Upper right-hand corner is a calendar icon. Click on that and scroll hard to the left. So swipe left till you get to 2053, and it's highlighted. You have to keep scrolling till it highlights 2053. Hit select and close. Now scroll down and you'll see total payments to date. Every dollar that left your hands that you took from your tenants is $402,747.56. But because the dollar loses value every time it leaves your hands and goes to the lender, you only gave the lender $152,466.23. So when you do the same exercise, I don't have a built-in calculator, but we've done this calculator before. iPhone, you can scroll up to the QJO investment tool. It's right there. Just download the QJO investment tool. If you pay off in 15 years, you actually pay more money. It's about 156,000 instead of 152. Why is that possible? People are like, there's all this interest I'm not paying. The reason that that's possible is because you're paying them more money while it's worth more. That's the big key here, is they're paying it more while it's worth more. Now, another reason interest rates are a reason that you don't want to get so wrapped up into interest rate being a thing, right? Is because who benefits? I'm going to ask Melissa and Nate here to debate on this. Who benefits when you believe interest rates are the most important thing?
Nobody. I mean, nobody.
You're saying who benefits in terms financially?
Yeah, who financially benefits when interest rate is your most targeted thing to focus on? Who?
I mean, I would say probably the banks and the stock market.
The banking industry,
trading the security of mortgage-backed securities.
The banking industry benefits the most. And why would they benefit if you're trying to get a lower rate? It's very interesting to think that. So, Melissa, have you looked at the amortization table on a 30-year fixed loan before?
Yes, I have.
What does the first 5 years look like?
The bulk of the interest is being taken by the bank.
Piles of interest on the front end, tons of it, right? So let me illustrate a little bit more about how valuable it is to get your mind away from this. I had a client come to us, he had a $120,000 mortgage when he started this loan. He came to us at month like 46 or 47, saying, I want to refi, the rates are down. So when he wanted to do this refinance, I'm like, dude, you've only been in the house 4 years. How much cash you want to take out? And he goes, none. I just want to get the lower interest rate. I've been told when the rates go down X amount, you should get a lower interest rate. I fought with him on it, but I couldn't convince him. I even showed him that when we dug out his payment schedule, his amortization table, he paid over $37,000 in principal and interest. $37,000, $120,000 loan over 4 years paid $37,000, right? So, but his balance only dropped by just over 6,000. 37,000 spent, 6,000 actually going to his equity. I couldn't convince him not to do the refinance. Now, between the lender fees, title fees, appraisals, inspections, I mean, not inspections, but the taxes, the insurance being added back into it, his costs were over 6,000. His total settlement charges were over 6,000. He added them to the loan. The new loan was within $102 of the original loan amount of 120,000. He literally started over again 48 months later at zero, but with a lower payment, thinking he was getting somewhere. Think about this. He took all that interest that he paid, got himself nowhere, got himself right back to the same loan amount, and started all over again. We even penned it all out for him, dropping 1% every time he refinances for the next 20 years, following the same pattern. He'll have paid out over $180,000 in interest, but had the exact same loan amount or a very similar loan amount 20 years later. That's why interest rate is so damned important to you, because you're feeding somebody a shit ton of it. If you get into the pattern we're talking about of paying your mortgage, total payments to date, like we have on here, I'll answer this question here, but the inflation adjusted payment is less, then you start to see the benefit of taking a long time to pay it. Now, inflation adjusted, you got the total payments to date on this one, $402,747.56, meaning the total of those payments. You look up top, principal and interest, $1,118.74 over 360 months is equivalent to $402,747.56. But every time the dollar leaves your hands, because of inflation, it's worth less than it was the month before or even the day before. So when you recalculate the value of every dollar as it leaves your hands, compared to the day you borrowed the 160, because it's worth a certain amount on day one, it keeps getting worth less and less and less over 360 months. The value of those $402,000 compared to the value of the dollar the day you borrowed the money is only $152,000. It's a lot to wrap your head around, but that's why you ride this thing out. What's really, really other interesting thing here, you've got payment of $1,118.74, inflation adjusted payment of $102.30. What that means is to buy $102.30 worth of crap today will cost you $1,118.74 in 30 years. You don't believe me? 20 years ago, I went to Taco Bell, 20 plus years. Got 2 bean burritos, 2 tacos, and a drink off their value menu for $1.99. 2 months ago, I drove through a drive-through with my daughter. That's what she wanted. I bought her that same damn thing. Cost me 15 bucks. That's how much it changes in that window of time. That's why this is not inaccurate. Now, these are not my numbers. These numbers come from the professor of accounting at Kennesaw State University. He heard me theorizing about the time value of money on the podcast. I couldn't come to the conclusion of what you really pay over time the longer you take to pay. And so, because we couldn't come to that conclusion, he invited me to come speak to the students, and I talked to them about a lot of stuff we're talking about here. And they created this tool for me. That this tool now created this app. This is actually comes from an accounting department at Kennesaw State. Is where this math comes from, not from Aaron Chapman, because I couldn't come up with it. So yes, it's like a reverse time value of money calculation. It's a way of showing how stretching out your repayment actually benefits you. Because if you took all that money and paid it all cash, let's talk about that for a second. Paying cash for a house. My opinion, it's very, very foolish when you have money available to you as cheap as it is right now. If you took that same $200,000 and you had bought a house cash, and you're getting $1,800 a month rent, you're probably making $1,500 a month in cash flow. That sounds awesome, right? But what if you can distribute that over 4 houses and make $200 a month cash flow, right? Not a ton of money coming in, $800 a month versus your $1,300 or $1,500 or wherever that was. I think it was $1,500. But over time, every time you raise rents, right, that $54, that $54 is not a big percentage of that $1,500. That $54 on a 3% increase in rents is a big chunk on that $800, because it's 54 times 4, right? So now you're talking about $216. Your $800 just became just over $1,000. Then it does it again and again and again. Look at where you're at in year 5. Now, not only that, but you have 4 sets of tenants paying off your mortgage. We established as they pay down that mortgage, that's a 20% increase on your investment. You don't have a mortgage over here. If you pay cash for a house, there is no mortgage. There is no increase on investment there. It's only the appreciation of the house. Well, we established a baseline number of 2.5% appreciation. So you're making 2.5% on your 200,000. But if you distribute your 200,000 over 4 houses with 20% down plus costs, right? Now your 2.5% is, what did we establish for? 15% or 10% of your 200,000. Look at the compound growth. Putting money down, an enormous amount of money into something for a little pittance called cash flow is not worth it when you think about the long run. The long game is huge for you. Plus the tax benefits that come from somebody else paying the mortgage, but you writing off the interest. So what other questions are popping up here? I know that I'm hitting you with all kinds of different things. And I can sit here all damn day. I mean, if you guys got questions, I got answers. They may not be the right answers, but they're the right answers from my experience, from what I have seen. This is not a one size fits all. I believe it is. I believe it to be a one size fits all, but also all people have to have their mind in the right spot. What I failed to cover, Nate and Melissa and everybody else.
Our brains are literally just like absorbing the information. You spilled out a lot of amazing stuff, and literally my processing is still moving.
Yeah.
I want to caution everybody real quick here, talk about the process still moving, because you're going to get on a phone call with me at some point. We're going to talk about interest rates. There's a good chance of us talking about interest rates, say mid sevens, that has a couple points. Your brain's going to fry at that point too. Like, holy crap, it wasn't that long ago it doesn't matter what you got before. It's what we're getting down the path. It's going to get worse. You're going to get tempted to start shopping. And here's the thing I find really, really, really interesting. You call me because we've developed some sort of thought process here. You think, okay, I'm going to call that someday. Then you get an interest rate quote. I'm like, wow, that sucks. I'm going to start calling. You spend 2 weeks calling the cheapest in the market, right? The internet guys who really don't know how to close real estate investor loans. There's a good chance your deal might fall apart. But you end up finally finding somebody who has an acceptable interest rate, but that interest rate's higher than the one I quoted you because the rates are going up so damn fast. Just get with somebody you trust to get the deal done, because you could lock out an amazing rate compared to what you thought it was. And if it doesn't close, you lost it. It's gone. Right? Sometimes there are people that are cutting a lot of corners, cutting out a lot of personnel, but they need those personnel to be successful at real estate investment loan closing. The temptation to get an arm is high out there. Protect yourself from the arm. If somebody suggests it, walk away. They do not understand. So when you're talking about the down payments less than 20%, yes, they're still possible. We can still get those. It's 50, you can do 15% down. There's mortgage insurance, there's higher interest rates, but if the deal will do it, it's just a matter of whether or not the deal can handle that particular situation. The 40-year, it is not being normalized. There's people talking about it a lot. It's being talked about for other types of loans, not for investors. There is a 40-year out there that is interest only for 10 years, then a 30-year AM. That's 15 years of interest you're paying the banks. They want you to take that damn loan. I caution against it. I don't think it's a good move. If you're going to be paying on something and you're going to get this acceleration and all these things, let the 30-year fixed work for you. Don't stretch out your interest heavy period. I don't agree with that one. That's the only one that I'm aware of out there that has a so-called 40-year type of table to it. There's another one out there people are talking to me about. It's called the all-in-one, where you get an arm to buy a property. It's a credit line. Great concept. I sold the shit out of that back in the early 2000s when I was with Countrywide. I was the largest single originator of that type of loan within Countrywide at the time. But then when the market shifted, the banks saw what was happening, they shut off everybody's credit line. What they did is they got a credit line on their house. And what they do is they take their income, their paychecks, they put that in to pay down the credit line as their payment. Then they'd use the credit line to pay their bills. And it was a great way to pay down your mortgage and not pay interest. But then people's patterns were seen. When they make that payment, the banks waited till the payments came in, then they shut off their credit lines. Nobody could access their money to pay their bills. Interest rates are going up. They will shut off your damn credit line when they want to. That can lock you into a bad spot. I don't recommend that loan. A lot of people say, well, they do that in Australia. They just, I don't give a damn. We're not in Australia. I know they do that crap overseas, but it doesn't mean that's the right thing for you. We're one of the only places in the world you can get 30 years. When somebody as smart as Warren Buffett says it's the greatest financial instrument in history, you got to listen to that guy.
Yep.
I love it.
Hey, Aaron, somebody's asking on here, how do you figure out your sunk cost, the initial down payment? I'm not quite sure what that means, sunk costs. I'm not quite sure what that means. Do you have any thoughts on what that might mean, Aaron?
So, good question. How do you figure in your sunk costs? The initial, and so the sunk cost, The only thing that I can think of when it comes to sunk costs, and you might want to clarify that a little bit more on your question. I've run into some folks that will go, and this is where my mind goes when you bring up sunk costs. When they're looking at a property and they're starting to do some investigation on it, they spend money on appraisals and inspections and all these things. Like, I don't know if I should buy this property, but I've already spent $2,000. Well, you spent $2,000 to buy to avoid buying a piece of shit, is what you did. And then when you find a piece of shit, you don't go still buy it because you spent a lot of money figuring out that's what it is. You use that capital to walk away from something, not force you to go further into it. That's where I think when I think sunk costs. Now, in the sample on my app, it's asking about the interest square, say $1,000. I'm seeing interest. See here, when I look at this. Oh, actually, I think you're probably looking at you didn't accelerate. You're just looking at 2023, maybe. Yes. So that's the interest being paid right out of the gate is $1,000, $118 towards principal. And as you continue to pay, interest will drop as your balance drops and principal will continue to grow. That's why it says 1,000. You can go up to the upper right-hand corner. They're getting on that one, and you can scroll over. You touch that calendar icon, the upper right-hand corner, and scroll every year. You can select and close, and you'll see how the interest drops because you're paying less interest and more principal over time. So that will give you the ability to see how the time value money plays things out over a period of time and how interest is influenced, how principal is influenced.
Perfect. What other
Hopefully
questions?
that answered well on that sunk cost thing.
We've got about 4 more minutes here that we promised you guys an hour. Does anybody else have any questions? Type it in there for Aaron. We are recording this. You guys might need to rewatch this and rewatch this several times. Like I said, I have seen Aaron give similar presentations for years and years and years now, and I always pick up like on a new little piece of nugget that I'm sure he has said before, but it maybe took him 5 times for it to actually go inside my brain. So we are recording this. Reach out to Aaron, Nate, myself, whoever, and we will send you a copy of this. I'm going to be posting it on my YouTube channel as well. So please rewatch this. Oh wait, look, here's a couple questions here for you, Aaron.
So yes, we do offer non-recourse loans for investors. I have a very, very broad scope. It used to be focused a lot on your conventional 30-year fixed stuff, but now we have a lot of your DSCR, other non-recourse. We have construction loans. We do all kinds of things. So you guys have Melissa and Nate just go out there and just go property hunt like madmen, and we're finding different ways to go with that. You can stumble across a portfolio of 5 houses that they can find you, and I have a blanket loan to do that, $250,000 blocks. So there's a lot of different things we have available to you. DSCR loans, I think they're a great instrument to use when depends upon the situation, right? If you're in a scenario where you've got all your Fannie and Freddie deals up and you just have to use DSCR, yes, we'll go for those, and there's ways to tailor it to fit you. If you've got a deal that's like perfect and you cash flow like a madman with anything, then look at the DSCR and don't suck up your other ones. Use those for the ones that are a little bit leaner, your conventional loans. I put my personal cell phone in the chat. The reason I put my personal cell phone in the chat is because it doesn't take you long to find the damn thing anyway. It's everywhere. So what I encourage you to do is if you want to talk a little bit more to any of us, I don't care who it is, Nate, Melissa, myself, text me there and you say, I need to talk to so-and-so. And then Bree I will forward that text to Bree. I will just sit here and forward text all damn day long to Bree, and she will reach out to you and sync up your calendars with any one of us. Because I am big into that. I hate Calendly, just to tell you. I'm not trying to be a prick for those who like it, but I hate that thing. I love the personal touch that Bree is. Bree is the only person I've ever met in my life that can give you a hug over text. So she will be able to guide you and make sure your calendar matches with anybody else's calendar, because we find it very important, all 3 of us, that you have the personal time that we can block out our schedules, ignore the entire planet, and just focus on you and what you have going on right now. Because if you're not successful on your first transaction, it's a pretty damn good chance you're not going to be around for transaction number 10. I don't care about number 1 or 2 or 3. I care about number 10. And let me tell you why. In our industry, the average person in my space right now is closing between 1 and 2 transactions per month. Actually, 0 and 1 transactions per month right now. If you came to them and you said, hey, this deal looks pretty shitty, I'm not sure if I should be doing this deal, but you're anywhere from 50 to 100% of their income that month, do you think they're going to really, really work hard to encourage you to close that transaction? Because they need to bread their table. I'm not trying to be a prick here, but we're closing a lot more transactions than that. If I don't close your one deal, it doesn't affect my ability to bread my table or my ability to pay my staff. But if you don't close number 10, it affects us. I need you to be successful, not just one. I need you to be successful 10, 15, 20. We have right now a subscription-based society being built all around you. If you're not noticing, that's because you're not paying attention. They're doing everything they can to make sure that everything you do has a subscription associated to it. Your housing, what you eat, what you do, your entertainment, Netflix, all that kind of stuff. BMW tried to make you a subscription-based car owner. They tried to sell you a hot rodded out car for mid-range price, but you had to subscribe for all the features. You couldn't have a seat warmer unless you paid a monthly fee. So you just don't do it during the summer, right? You couldn't turn on your radio without a monthly fee. That didn't go anywhere, but they're heading that way. The reason I bring that up, take advantage of the opportunity you have right now to be one of those subscriptions, which is the landlord of the property that they will rent. Don't hold back. Now's the time to do it. Our rates are going up. Our property values are going up. There's less inventory because people are hanging on to their houses and nobody's building. The National Association of Home Builders has targeted apartments. You want to play in this game, you got to get in the game damn now. Text me. We will get you set up with any one of us and make sure that you guys have the opportunity to start now and stop sitting on the sidelines. Let the other people not do anything.
Love it. Love it. All right, guys. Well, I know it's 1 o'clock here. Aaron, I want to thank you tremendously for jumping on here and educating and schooling all of us with that finite brain of yours. It's amazing, like the stuff that comes out. Melissa, is there anything else that you want to add?
Nope, I'm not going to ruin it. He closed it perfect.
Right.
So.
I appreciate you guys. Thank you for being on here. Thank you everybody who jumped on here. There's 30 or there's 40, I think almost 50 participants at the peak. Thank you for allowing us to have some time with you. Do not hesitate to reach out to us. We're looking forward to it.
All right, guys. Thank you so much.
Amazing. Thank you guys. Thank you, Aaron. Thank you,
Take care,
Bree.
guys.